Why go it alone? Crop West Insurance gives you expert support, better commissions, and in-depth educational retreats that set you up for success. They've spent 60 years perfecting the art of growing crop insurance agencies, and now it's your turn to join the movement. Crop West Insurance, where agents come to thrive. To find out more, please visit cropwestinsurance.com. Crop West Insurance Incorporated is an equal opportunity provider and employer. Hey there, and welcome to the Crop Insurance Podcast. I'm your host, Mike Rydell, a third-generation crop insurance agent, and I'm here to help you navigate the ins and outs of crop insurance. It's what my family's been doing for generations, so you're in good hands. Our goal here is simple, to educate our listeners. Crop insurance can be complex and overwhelming, but I believe that understanding it is crucial for every farmer. So whether you're a seasoned farmer looking to stay updated or a newcomer seeking guidance, this podcast is for you. Hey everyone, and welcome back to the Crop Insurance Podcast. I'm your host, Mike Rydell. Today we're going to be tackling a tool that can be a game changer for your operation, and it's called margin protection. While it might sound complex, we're going to be breaking it down into simple terms to make sure that you walk away with a solid understanding of how this program works. This episode is the first part of a two-part mini-series, so buckle up as we explore the key concepts today before diving deeper into the details next time. So what is margin protection? Well, at its core, margin protection is a safety net for farmers that's designed to protect profits in ways that traditional crop insurance policies cannot. It is an area-based risk management tool, meaning it doesn't measure losses at the individual farm level, but rather at the county level or your area. So what this means is that your coverage, your payouts, and losses are determined by the countywide data. You could personally experience a loss on your farm, on your underlying crop insurance policy, but not qualify for a payment if the county doesn't as a whole. Conversely, you could receive a payment from margin protection even if your individual farm does well, as long as the county experiences a margin shortfall. So it is an area risk plan similar to ECO and SCO, and that it relies on your area or your county when you purchase this product. Now keep in mind that margin protection is not available everywhere or for every crop. So make sure you check your county actuarials to see if this program applies for your operation. In order to understand how the margin protection policy works, we need to understand a few key terms first, because margin protection revolves around a few core terms that are crucial to understanding how the policy works. The first one is your expected revenue. Now, this is the revenue the county expects to generate based on historical yield data and the projected price for a given crop. The formula for expected revenue is your expected county yield times the margin protection projected price. Now, the projected price in margin protection is set a little bit differently from standard crop insurance policies, and many farmers actually prefer this method because the price discovery period aligns better with the planting timelines. The next term to understand are the expected costs. Now, this represents the estimated input costs for farming that crop. Some of these costs will remain fixed while others fluctuate. Some examples of fixed costs are seed and machinery and things like operating costs excluding fuel. Some of the variable costs or costs that can change when figuring out your expected cost are diesel, fertilizers like urea and potash, and things like interest rates. Now, these costs are determined by the county actuarials and play a key role in determining how your margin protection coverage is structured. Now that we know a little bit about expected revenue and expected costs, the third term that's a key to understand is expected margin. Now, your expected margin is simply the difference between that expected revenue and your expected costs. The formula for expected margin is simply expected revenue minus expected costs. It's that easy. And now that you have this margin, it's the foundation for your insurance coverage, and it helps determine that baseline from which your losses are measured. So how do these calculations work? Well, now that we understand expected revenue, costs, and margin, let's explore how this turns into actual protection for your farm. Since this is an area-based plan and everybody's pulling the same expected revenue and cost and essentially coming up with that same expected margin calculation, every farmer in your area would have the same protection. Well, the nice thing about margin protection is that it has different factors you can apply to your policy to tailor it for your risk tolerance. The first one is your coverage levels. So with your coverage levels under margin protection, you can choose between the 70 to 95% coverage level of your expected margin. The other key item that lets you customize your policy is the protection factor. Now that's a multiplier from 80% to 120% that adjusts your payout. Now, the higher your coverage level, in theory, the lower your deductible, but the higher your premiums. Similarly, a higher protection factor boosts the payouts, but it also raises your premiums. So you do need to quote these different options out and how it will apply to your policy in your area. So now that you understand where you have to pick your coverage level and your protection factor, let's look at trigger margins, harvest margins, and indemnity calculations. So your trigger margin is the amount at which your payment kicks in. And all the trigger margin is it's your expected margin multiplied times 1 minus your coverage level. So for example, if your expected margin is $500 per acre, and let's say you chose the 90% coverage level, your trigger margin would be $500 times 1 minus 0.9, or $50 an acre. So if you were at the 70% coverage level or 80% coverage level, your trigger margin would be different than your neighbors if they chose a different coverage level. The next piece of the puzzle is the harvest margin, and that's based on actual county-wide yields and prices. So first up is we have our harvest revenue. That's going to be your actual county yield times the harvest price. You also have your harvest cost, and that's going to be adjusted based on the actual input costs. As you'll remember, we mentioned there's fixed and variable costs. That's where those two different types of costs come in to come up with your harvest cost. And now your harvest margin is just going to be your harvest revenue minus harvest costs. So it's the exact same setup as your expected revenue, expected cost, and expected margin. But now we're at the end of the policy period, so we compare it to the harvest revenue, harvest cost, and harvest margin. And at the end of that insurance period, if the county's harvest margin falls below your trigger margin, you would receive a payment. And the way that indemnity payment formula is going to look is you're going to take your trigger margin and subtract your harvest margin. When you have that answer, you're going to multiply that times your protection factor. That's the one we mentioned earlier, where you can select a level from 80% to 120%. So would you rather receive 80% of your loss or 120% of your loss? The answer seems obvious. You would want 120% of your loss. However, you do need to take the premium implications into your calculations when you get this quoted, as the higher the protection factor will result in a higher premium. Now, your payments are determined on a per acre basis and then multiplied times your insured acres. And this will help if you have any different crop shares on different units to take those into account, as you're still going to have to take your share into account when factoring your loss. Speaking of payments, unlike other crop insurance programs, margin protection payments take time. Since it relies on countywide harvest data, just like ECO and SCO, the payments typically occur in June of the following year. So this delayed payout is very important to factor into your financial planning. Now, when we talk about margin protection and your other crop insurance programs, it's important to know how margin protection works with those other policies. A big key here is I know we keep mentioning SCO and ECO, so it should be noted that margin protection cannot be combined with SCO or ECO. It also can't be combined with whole farm revenue protection, area risk protection insurance, or any APH-based products. So here's why. Margin protection in SCO and ECO, so the supplemental coverage option and enhanced coverage option, provide additional coverage on top of the base policy. But margin protection is already an area-based risk policy, and since margin protection covers a broader risk at the county level, it cannot be stacked with either ECO or SCO. Now, with margin protection and whole farm revenue protection coverage, with whole farm revenue, that covers your entire farm's revenue rather than focusing on just one specific crop, and that makes it incompatible with margin protection. You must choose one or the other. Now, margin protection and area risk protection insurance, those are both county-based plans, so you cannot have margin protection and ARPI on the same crop. Now, I also mentioned how margin protection and APH products don't work together. Well, there are still individual APH-based policies, like some pilot insurance programs, and they may not be compatible with margin protection since margin protection relies on county-based yields, and some of those pilot programs won't have county-based yields in the county actuarials. You should also note that with margin protection, there is not a CAT coverage or a catastrophe coverage level. You have to choose from 70% on up to 95% as CAT is not available. So what can margin protection work with? Well, it can work with your base policy like revenue protection or yield protection. If you also carry the traditional revenue protection or yield protection policies, any indemnity that you receive from those policies, excluding the replants or prevent plant payments, those indemnities would be subtracted from your margin protection payout. This is preventing double dipping, and it also reduces the effective cost of your margin protection premiums, because if you sign up for margin protection and you have an underlying revenue protection or yield protection policy, you do receive a hefty premium rate reduction on that margin protection policy for carrying an underlying federal crop insurance policy. Now, this is a concept that should be familiar to those who understand whole farm revenue protection. The only difference here with margin protection is you cannot exclude that underlying policy like you can with whole farm revenue. Well, that was a lot of info, but hopefully this breakdown makes margin protection a little easier to digest. Now, the goal of this episode isn't to have you crunching your numbers just yet, but rather to help you understand how this policy might fit into your risk management strategy. Stay tuned for part 2, where we're going to cover things like the harvest price option, some real-world examples of margin protection payouts, also some important deadlines and requirements, and the common mistakes and misconceptions of the margin protection program. You won't want to miss it. If you found this episode helpful, please subscribe, leave a review, and share it with your fellow farmers. Thank you so much for tuning in, and we'll see you next time on the Crop Insurance Podcast. From my family to yours, thank you for joining me today. Explore more at cropinsurancepodcast.com, where you'll find episodes, articles, and tools to help you make the most of your coverage. Be sure to subscribe and share with your friends and neighbors. Remember, this info is just a guide. For specific rules, please refer to the Crop Insurance Handbook and your appropriate crop provisions. This institution is an equal opportunity provider and employer.